G'day expats and welcome to another episode of Expat Chat, episode 177 today, as our Kiwi friends across the Dutch like to say. And today we're going to give you guys a quick 15-minute wrap-up of the budget. So as always, joined by my mate and colleague and the guru from Australia on the APAC region, Mr. James Ridley. G'day, James.
Good morning, Brett. Thanks for obviously having me on once more. Another expat chat in the bag. For those who are tuning in via YouTube, on my left-hand side, you'll see Brett Evans, friend, colleague, founding director of the Atlas Wealth Group, currently over in the sandpits in Dubai, heading up our wealth management division for the Europe, Middle East, and Africa. How's it going, mate? What's the temperature like today?
Mate, we've been pretty lucky. It's been, summer's on the way, but we're getting a bit of a reprieve this week. So when you
Yep.
see the 20s on the dash,
Ooh.
26, 27 in the morning. It's like, I'll take that
Oh,
because before
yeah.
long, click your fingers and it's going to be 38 on the dash at 5 a.m. in the morning and it's all north
Shit.
from there. So, mate, maybe it's got
Gosh.
something to do with the missiles and the drones, who knows? But yeah, long story short, we'll take it for as long as we can get it. So, and mate,
Absolutely.
what a budget. What a doozy. I've never
Oh,
seen so many different people
Australian public's
affected.
angry.
Oh, exactly.
Yeah.
Adam Prentice, a colleague here in the Dubai office, uh, we're doing a seminars down in Abu Dhabi and Dubai last week. And he coined a great phrase and he said, in the past, we thought Labor just hated SMSFs and expats, but it turns out they hate everyone. And I think that's the best way to summarize the budget this year. But now let's keep the compliance officers happy in the world. Let's get that jingle out of the
Yep.
way. All the information we're going to
Yep.
share with you good folks today should be treated as educational and informational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, speak to a specialist like Atlas.
Absolutely, man. And yeah, I think, I mean, the general consensus back in Australia and probably is just the Australian public is just angry. They've really not read the room. They've targeted a lot of probably their voting base accidentally through these trust tax reforms, the minimum tax on the distributions. This isn't sort of your wealthy families or wealthy individuals. These are your
Yeah.
electricians. These are your plumbers. These are your plasterers. These are your builders. These are everyday hardworking Australians having a go. And now they've got no opportunity to obviously reduce their income taxes or anything like that. Minimum 30%. It's so punitive. It is just so punitive. So I I don't think it's going to have the legs to run it all the way through in its current form. I think there's going to be changes, tweaks, and to tell you what, if this is still kicking around by the time we come up to election time, could be kicking Labor out.
Yeah, look, they can lose 20 seats and still keep the majority. So they've got a bit of fat there to play with, but he's got to want this to be
Mm.
put to bed ASAP to,
Yep.
and let's be honest, people have short-term memories and they'll forget about shit and come around the election,
Yep.
the same people will vote him back in again and off they go again. So who knows? I mean, it depends on how effectual as an opposition the Libs are.
Oh yeah. Yep.
Pauline with One
My
Nation,
nation.
the Teals. So if they're smart, they will just sit back and don't be stupid and the voters will come to them. But
Yeah. Yep.
common sense doesn't always prevail in politics, and we'll see what happens there.
No, that's exactly right. And I mean, when we look at the budget, probably the largest tax reform budget that we've seen in probably the last 20 years, to be
Yeah,
honest.
my career.
And yeah, absolutely. So, and that's why there is just so much uproar and I'd say to a degree division. You've created more of a divide between the younger generations trying to have a go and crack into the property market versus the older ones, so the retirees who come up, they've held those property for years and now, they pretty much don't need to sell them. They can just keep them, keep the negative gearing rolling. So it's going to be very interesting. I think let's just start with probably the common topics and changes that have come out. Remember, when we see these budgets, it's rare that you have anything that's specifically hitting Australian expats. It's targeted for the Australian tax resident sort of obviously cohort, but there are some things that come out of it that either are maybe a silver lining potentially for Australian expats or, the other way,
Yeah.
much like when they removed the 50% CGT discount back in 2012, that was targeted. So let's run through it.
Mate, first cab off the rank is probably the most divisive and talked about one is property. And give us your T or DR explanation of property, mate. What are they doing on the property side?
So negative gearing is going the way of the dodo to a degree. So if you already own a existing property that is an investment property or it's your main residence and then you're going to rent it out in the future, you've already purchased it before budget night, um, you'll be able to continue negative gearing that property. So negative gearing is essentially using the tax deductions, the interest expense, the depreciation, that's usually more than the rental income. That goes against your wage income. You lodge that as a tax on your tax return. It reduces your overall taxable income and then you get a tax refund. That is negative gearing in a nutshell. The new changes will only allow negative gearing on essentially new housing that adds to the supply. So this is new builds off the plan property, units, apartment complexes, new duplex sort of estates, all those sort of things. That's where you can use negative gearing going forward. If you're buying anything that is already existing from now up until 1 July 2027 and further on, you can't use that property for negative gearing purposes. Effectively, what will happen is you'll create a bucket almost on your tax return where losses will accumulate for that specific property. Those losses will be eventually wound down when that property turns into being positively geared in 5, 10, 15 years time. Or if you sell that same property asset, you can use the losses to reduce the taxable capital gain. So some very punitive changes there. The other really important one is moving away from the old 50% CGT discount concession and now moving to a cost-based indexation model. Now, this model has previously existed already, existed back in the late 90s and early 2000s before moving over to the discount concession. This one is a little bit nerve-wracking because there's a two-piecer in there or three-piece. So if you're buying anything that's off the plan right now, and off the plan going forward, you have the option to either use the 50% CGT discount or the cost-based indexation method, whichever one is going to give you the least amount of taxable capital gains. That's part one. On those capital gains, you will always have to pay a minimum of 30% tax on capital gains that accrue from 1 July 2027. So any gains that accrue up until 30th of June 2027, you can still use those for the 50% CGT discount, old scheme, tax at your marginal tax rates. Any gains that accrue after 1 July, minimum tax rate of 30%. But if it's a new build, adding to housing supply, you have the option of using cost-based indexation method or the 50% discount if it's a new build. If it's an existing build and you're buying it after the fact, then no negative gearing on it, obviously talked about that already, but you'll be using the cost-based indexation method for that and still a minimum tax rate of 30% on that as well. We can definitely see the need for a lot of property investors needing market valuations as of 30th of June 2027. The ATO and essentially the fact sheet or the cheat sheet, I guess you could call it, coming out of the budget measures said that the ATO might be publishing some data routinely that I guess investors can use to help them sort of reset the cost base to a degree as of 1 July, rather than everyone being forced to go out and engage a property valuer to essentially value your property, because imagine the amount of work that's going to involve and the cost as well. That is, I guess, where it sits in the moment regarding CGT on property. But not only that, these changes in capital gains tax, they apply to all investment assets. They're not just applying to property. And I think leading up to the budget, we probably assumed, oh, it's only going to apply to residential property. They're trying to improve the housing crisis, which is mainly just drawn about by housing affordability, which is due to the lack of housing supply. This doesn't really fix it, to be honest. It's just rotating investment capital into new builds, technically, rather than existing. But just remember, new builds off the plan, these things are usually promoted to first home buyers because they get these little kicks. They get, no stamp duty concession or a first home buyer's grant or something like that. So they've really missed the mark here, to be honest. And it also means that rents will be going up in Australia. Now, in terms of how this change applies to other vehicles, Companies have never been able to tap into this concession, the 50% CGT discount concession, nor the cost base. So nothing happens for those using companies as an investment vehicle. It will apply to trusts, discretionary trusts, family trusts, all those sort of things. It doesn't apply to superannuation. That's good. So it's mainly individual investors and trusts, which is probably the most common entities, vehicles, individuals that using these kind of strategies. Um, there was an inflection point where the cost-based method was the indexation cost-based method was actually a little bit better than the discount. Do you remember that one? The
Yeah, so
indexation amount?
if you bought a property for 500 grand and held it for 15 years and that property went to 1.5 million, in order for the new indexation method to be the better way from your point of view, not from the government's point of view, but from the property owner's point of view to hold,
Yep.
it has to average 4.7% per year for 15 years. Now, a lot of folks out there understand what inflation is and everything,
Mhm.
but I guarantee not many people know what the current rate of inflation is or what it's been over the last, back to the 80s. And just as a FYI for folks, it's never done that. It's never, inflation has never been above 4.7% every year for 15 years straight. So
Never.
essentially the numbers we worked out, and you can go onto our YouTube channel where you can see us presenting these numbers to give you a full breakdown. So jump onto YouTube, type in Atlas Wealth Group and have a look at the webinar. Um, it's never done it. So pretty much for the vast majority of everyone, this is a worse system. The other funny thing too, we're getting a lot of questions and I love how expats think in these seminars and webinars like, okay, so if I have a house and I demolish that house and I rebuild a new one, can I make
Yeah.
that? Can I make that
Yep.
one under the negative geared? The answer is no, because not,
Mm.
as James said, not adding to supply. You could
Yeah.
potentially, and once again, and for those folks who joined us for the seminars and the webinars, you heard us 1,000 times say, until we see the draft legislation, we don't know all the facts because,
Mm.
that's where the devil's in the detail. But potentially you could demolish a house, subdivide it, and then put two townhouses up or two houses up. That's adding to supply. So theoretically, that's right.
Yeah.
But yeah, so there are some flexibilities there. There's some options there. But what was interesting, actually, Macquarie, I mean, bearing in mind this, a lot of these things don't kick into 1 July 2027. Macquarie were first bank off the cab off the rank on the banks to suddenly remove the negative gearing ability in the servicing calculations for new loans. And now other banks are starting to follow. So what it's essentially
Mm.
done, it has reduced people's borrowing capacity on investment properties by 20%, which is
Mm.
huge. So
Yeah, it is.
combine that with, all the interest rate rises we've had this year. There are some bloody strong headwinds coming coming the way of property. And, if and look, real estate agents are great people, but do I trust what they say in the press? No, because they like to talk their own book. So I like to look at the numbers. So I'll be watching SQM and those sort of market research firms over the
Yeah.
coming months just to get that
Yep.
impartial impression of, okay, has it had the desired effect on property? And the I think what's pissed people off the most is the fact that this was sold on intergenerational inequality, solving the housing problem. How is changing trusts or shares going to help housing? Like it's just been an absolute tax grab, and I think
I
everyone
know.
can see through that. And I think the fact that Albo went to the election previously, he said we're not going to touch capital gains
Oh,
tax and we're not going to touch negative gearing, and within 2 years, bang, he just couldn't get his hands off the out of the cookie jar.
I know it's remarkable, but I mean, for those that are listening, just remember, as a non-resident, you don't get negative gearing anyway. You're accumulating losses, so you get to use when you come back. There's no changes there. But right now, if you're overseas, you're just accumulating the losses, and this is the exact same model that anyone in Australia will start to experience. So, um, it's definitely changing things. They pretty much broken promise immediately,
Yeah.
and that's just done the rounds. How said no, we won't touch negative gearing. No, we won't touch obviously the capital gains tax, and it's the first couple of things that they obviously are touching. Let's talk quickly now about trust because we haven't really talked about it.
Yep.
So the biggest change with Australian discretionary trusts, so this also includes testamentary trusts, is that they are applying a minimum 30% tax. And when beneficiaries receive an income distribution from a trust, it'll have a 30% tax credit attached to it, but it is a non-refundable credit. So that means, and Ben Turner, manager director of Atlas Tax, he gave a great example. He said, effectively, if you're receiving right now an income distribution from a trust that's say $50,000, when you receive that, assume you got no other income in your income tax return, your effective tax rate on that is about 13% once you pay the tax. Now, the difference here is you receive the net amount on that distribution. So let's just say you receive the $50,000, but it's got the 30% tax credit attached to it because of the minimum tax from the trust. You're effectively paying, what was it? What did it end up being? It was an extra $15,000. So you're paying essentially an extra $9,500 under the new rules in tax, but you
Yep.
don't receive that as a credit for anything else in your tax return. You will not receive a refund from it.
Yep.
So punitive. The the stealth tax that they've put in, which is why there's a bit of a pause on this one, is it would apply to testamentary trusts. Now, testamentary trusts are estate planning vehicles which get created upon death. So if we've got a will, we pass away, it's very common that your assets are then pulled into the testamentary trust. And then over time, they're held in there, they're sold down slowly. A great benefit of a testamentary trust is that it's taxed like an individual. So the effective marginal tax rates apply to the income, apply to the assets as they're wound down. Through this new reform and legislation, it would effectively apply a minimum of 30% tax on essentially assets that are transferred into a testamentary trust from death. So it means that this is a death tax. This is essentially a state
Yeah,
tax. We don't have gifting tax or inheritance tax or estate taxes in Australia,
we do now.
but this is effectively applying a minimum 30% on those. So very punitive. It also means that if you're using a corporate beneficiary under a trust, it pays an extra layer of tax as well. So you're double taxed if you're trying to put money into a corporate or a bucket company. That one means that in the current form, if this legislation run through, it renders bucket companies useless, absolutely useless.
Yeah.
I'm nervous of that one because I know a lot of our clients, they love using bucket companies. I know a lot of advisors and accountants that love using bucket companies as well for their clients. So I just can't see this running through as is. Albanese did come out in the last 48 hours and says we'll probably push pause on this trust legislation and release it later in the year because they need to go back and rework it based on the testamentary items.
Yeah, the folks in Treasury cooked that one, didn't they? So
Absolutely.
it sounds like Treasury actually had more control over the budget than Albo and Jimmy Boy, because
Yeah.
I was actually talking to some people who used to work at Treasury over the last couple of weeks, and they said this has been their Christmas list for so long.
Yep.
They've said, please, 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 sir, can I have some more? And
Do it all.
do it all. Yeah, just bang. And just to
Yep.
circle back to on 2 points on the property side for expats. So as
Yep.
far as expats are faced, there is a potential silver lining, two potential silver linings. One for
Yes. Yeah. Good
expats
point. Yep.
is at the moment, as we all know, we don't get the 50% discount when it comes to calculating the capital gains. Now that the 50% is going, there is a chance, and once again, the devil's in the detail, and we'll wait for the legislation to come through, there is a chance that expats will also be able to use the indexation method as well too, which is
Yeah.
a good result. So for once,
Yes.
yay,
Good
expats,
win.
good win.
Yep.
The second one is, and this is not a silver lining, depending on the person. So properties are often sold to expats by the spruikers. We all know their names. I'm not going to talk about them on the call, because they say, buy a property in Australia, you can't negative gear, you accrue income losses, and then when you come back to Australia, you'll have $100,000 of income losses that you can then offset against your income. Under the new proposal, you can't do that. It only can be
Mm.
offset against the property. So if you hold that property for 20 years, you have to wait for 20 years for that benefit.
Mm.
And all depending on your numbers, how much of a shortage of cash flow it is and how long it takes to turn positive or how long it takes for you to sell it, you could be waiting a while. And Adam and I were running some numbers the other day out of curiosity, and they said, if you put $10,000 a year in, it's $100,000 over 10 years, if that's what your losses are over that period of time. If you put 10 grand into an ETF and added 10 grand every year, after 10 years, that's worth 167,000. So the math has changed when it comes to whether you buy a negative geared or sorry, negative cash flow property, because you need to look at your ROI on the money you're putting down because essentially the ATO owes you that money, but they're not going to pay you interest. They're not going to give you that benefit. So just keep those two things in mind.
Yeah, absolutely. Absolutely. It's such a massive change forthcoming. Again, I think there'll be a lot that doesn't get through. I feel like they've thrown everything at the wall to see what sticks, and they'll accept one or two things.
Yeah, let's ask for 20
But
things and only get five.
that's right. I mean, Labor could have been very smart and he goes, this is the only thing we want, but let's layer it with a lot of damaging tax reform and just see what we
Yeah,
can get through. It's not a bad strategy because there will be something that gets through. It's likely to probably be a bit of negative gearing and some changes to the discounts concession because we've had that before, the
yeah.
indexation model. They tried negative gearing and getting
New
rid of negative
Zealand,
gearing in New Zealand, but that didn't last. They brought that
two
back pretty
years.
quickly.
Yeah,
Property market was taking a dive. So with that in mind, it might not last. We already know if Labor gets in, if Liberals get into the coalition, they've already said they'll repeal all of it.
yeah.
So it's yeah, just so punitive. One thing I'll add to this as we wind up for today's session is Division 296. This is that tax that applies, that additional 15% tax that applies on superannuation balances over 3 million and then 10% on 10 million. When they announced that, that was early 2023, and that was meant to be legislated and apply as of 1st of July 2024. That piece of legislation didn't actually come in and come through until March 2026 to apply as of 1 July 2026. So that is just a quick example of significant tax reform taking up to 3 years to actually move through and get legislated. So that does mean that this could take a little while. Obviously, the design of Parliament right now and who holds all the votes is different. Obviously, the Labor has the numbers, but they'll need to get on side with the Greens. Greens might not like this. We'll wait and see. But they certainly have the numbers to run this through in the House. Absolutely.
Definitely. So, and mate, and also just on super, the good news is wasn't touched. So
No.
that 296
Yep.
has been legislated for a while, so ignore that. There's
Yep.
been no
Yep.
announcements. So, client said the other day, so he goes, if all this gets through and I move back to Australia, where do I have my money? And I said, two locations, PPR and super, tax-free and tax-free. That's it.
Yeah.
Don't
Yeah.
worry about
That's
anything
right.
else. Just max out your super, max out your property. And
Oh, yeah.
it's
Yeah. I
sad.
can.
And yeah,
So people are already getting creative. Those that live in main residences that they bought a few years ago, they're already talking about, well, maybe I'll just move out and rent a place and negative gear the shit out of my old main residence.
yeah,
So like that, things are changing already in the way people are thinking about these strategies and how they can still benefit from the tax system and then move back in within a 6-year period and reset it and make it tax free again.
MRE.
So
I
yeah,
think
exactly.
actually
There's always
that
ways.
you raise a really good point there. And I think this is what the overall agenda is. They want to remove property to be seen as a wealth creation tool and more of a establishment, a place to live. That
Mm.
to me is what Labor's trying to achieve. They're trying to strip it away. UK's done exactly the same thing. And UK property market has just been on the way down ever
Oh,
since. They can't do negative
dog's
gearing. They can't.
breakfast.
It's
No.
just a mess. So
Yep.
I think that's what they're trying to achieve. They're trying to change the narrative on property, not that
Mm.
you can climb out of, the trenches and make money by buying property. It's more go and buy a house that you can live in that call your home and then just work harder. And I think they're
Yep.
trying to indirectly affect productivity because as we know, for 20 years, productivity has been on the, on the down and
Yep.
trying to get people to work harder and earn more.
Yeah, yeah, absolutely. And I mean, that's a really good probably summary and snapshot of the 2026-2027 federal budget. It's a watch this space because next steps is receiving the first tranche of draft legislation. That is going to be where the devil will be in the details. We'll be unpacking it. Keep an eye on our blogs. We'll probably do another webinar as well and be definitely talking about it on this podcast.
Definitely, mate. And appreciate your time and thanks, folks. And we'll see you next week.
See you next week, guys.
Cheers.